In this video, I will show you the main differences between the SBA 504 loan program and the 7A loan program, two of the most popular loan programs for business owners by the SBA. Hey everybody, welcome to my channel. I'm your host, Leo Landaverde, business coach and outsource CFO, helping you scale your business. If you're ready to grow your business to 7 figures and beyond while creating the financial freedom and the lifestyle you want, then don't forget to hit the bell and subscribe to this channel, and you'll be notified every time new content comes out. A couple of weeks ago, I did a full video on the 504 loan program, and last week I released a video talking about the 7A loan program. Today, we're gonna look at the difference and similarities between the two. If you haven't watched any of them, I strongly suggest you do, so you'll make this video in context. It will help a lot better. The link for both videos will be at the end of this video, so stay tuned, watch it to the end, and you should be able to click both. I would encourage you to save all 3 of them because they're very, very powerful. So we're gonna start with the main differences. There are 4 of them. Number 1 is the amount you can borrow. With the 504 loan program, you can get as little as $125,000, and you can get all the way up to $20 million. That's right, up to $20 million for a project. With the 7A loan program, you're capped at $5 million. So it's important that you know how much money you can get with either. Number 2, use of proceeds. In other words, what you can use the money for. With the 504 loan, you can use it only for 2 things, and that is commercial real estate that is owner-occupied and heavy equipment. With the 7A loan program, you can use it for business acquisitions, you can use it for working capital, partner buyouts, real estate and equipment. Yeah, that's right, you can also use it for real estate. It is a whole lot more flexible than the 504. So again, the 504 is mostly for commercial real estate that is owner-occupied in heavy equipment. And you can use the 7A for the rest. Number 3, interest rate. This is an important one, and pay attention. It's either gonna be variable or fixed interest rate. With the 504 loan, it's gonna be a fixed interest rate for the duration of the loan up to 25 years. But if you remember from the video on the 504 program, it's a blended rate. So you're gonna get the first with the participating bank that is maybe up to 25 years. And then the second, it's gonna be with the CDC, the Certified Community Development Organization, that is gonna actually guarantee the 40% or the 50-40-10. And that one has a length of about 20 years. So the blended is 23. So more on that, that's what I want you to watch the other video. With the 7A, is a variable interest rate. So think about what you're gonna invest it for. Now, the biggest difference, and usually what comes up, is why cannot not buy commercial real estate with a 7A loan? For the simple reason that when you buy a fixed asset like commercial real estate, you wanna have fixed payments. So if you're buying real estate for your business and you wanna go from renting to owning, you wanna have a predictable fixed payment. You're not gonna have that with a 7A loan. It's gonna be prime plus a couple of points, and it's gonna be variable. That means that it's gonna go up and down with the fluctuations of the market. You do not want that, a fixed asset with a variable interest variable payment. So those are the main differences in the interest rate. Number 4, collateral. The 504 only collateralizes either the real estate that you're financing or the heavy equipment that you're purchasing. So the SBA will put a lien on either the real estate or the equipment, nothing more. The 7A loan program by law, by statute, is a fully collateralized loan. This means that there will be UCC filings, there will be life insurance as a condition of the loan to have life insurance on the owners. There will be liens on your personal residence, accounts receivable, and last but not least, a personal guarantee. Now, the personal guarantee, I'll discuss that in a little bit later because it's more of a similarity than a difference. But if you're trying to compartmentalize risk, the 7A is not a good idea because you want to limit your exposure as much as possible. So if you want to get commercial real estate, definitely the 504 is your choice. Now let's look at the similarities between the two loans. All right, number one, both loans require personal guarantees from the borrowers, and anybody who owns 20% or more of a membership in an LLC or shares in a corporation, whether it is a small corporation or a C corporation. But you know what, personal guarantees is just par with reality. That reality that they live today is that if you go to any bank and you're not dealing with the SBA, you're still going to have to personally guarantee the loan or the line of credit. So that is you just have to get used to the fact that if you're going to get a loan from the SBA, you're going to have to personally guarantee it. What does that mean? That if the business doesn't do well and it goes out and it falls and you basically go out of business, you still have personal responsibility on that loan. So it's good to know that with eyes wide open, when you're pursuing a loan that is backed by the government, you will have to personally guarantee it. That's different than collateralizing the loan that I said earlier. Number two, both loans have prepayment penalties. And you're wondering, why is there a prepayment penalty? Well, you're probably not gonna get a better interest rate anywhere else. So for the privilege of having a 2.4 loan on a 504, and it's assuming that it's fixed, that you're not gonna be able to get there anywhere else, there's gotta be some give and take. So the SBA will put a condition on your loan covenants that you cannot refinance for the first 3 years, that if you prepay, there are limits as to how much you can prepay. I don't know exactly what that is, but whether it is 1 to up to 2-3% of the loan, you cannot prepay until that prepayment clause is over. Number three, you can use the two loans for the same project. Say for instance, you were trying to build a ski resort in some area in your state where there's snow, and you needed to have as much capital as you could. So for instance, you could actually use the 504 loan to get the real estate and the construction of it. So basically buy the land, construct the building, and get the heavy equipment all wrapped up into the 504, and you can use the 7A for everything else. You can use the 7A for the working capital. You can use the 7A for acquire other things that are not necessarily covered by the 504. So they both loans are complementary. Isn't that cool? Nowhere else will you have that much. And I forgot to say that earlier, in the 504 loan is the only loan in the market that only allows you to put 10% down. Yeah, that comes with some strings attached. So if you're looking at a 10,000 square foot building, if you wanted to buy a commercial, office space building, you have to occupy 51% of that space. So anyway, so just to recap, the similarities: one, both requires personal guarantees, both loans have prepayment penalties, and you can use both loans on the same project. Hopefully this video was helpful to you. Thank you so much. Please comment below and let me know which of these two loans will you take and why. Love to hear your comments. Also, if you want to join a community of like-minded successful entrepreneurs just like you, then join our Facebook group at the link below, where I share tips, tactics, and strategies on how my clients are growing their businesses to 7 figures and beyond.